Let's talk about Celsius to start off the week. They're going to bankruptcy court this afternoon, and we got a nice snapshot of their current asset holdings and liabilities last week, including a few interesting details. One bit, they included $600 million, I believe, attributed to their token CEL, but in reality, it's only worth around $120 million just because the asset itself or the token has depreciated in price so much since Celsius blew up. Also included some interesting notes, like some mining operations that it runs. Actually has a decently large mining operation up there in terms of like the size against other private companies. As CoinDesk reported last week, the prices of ASIC miners, the Bitcoin miners themselves, is also quickly depreciating. So that means that Celsius is probably overstating how much these assets are actually worth. And then you get into the liabilities, right? And we reported last week that there was a very large hole in their balance sheet from one particular company, Equities First. I think it was near $500 million in outstanding debt from that company. So just looking at the total picture, it's pretty rough. Like there's not a good way of looking at this saying like things are going to be okay. Of course, the most important thing now is for retail and anyone who is involved with Celsius. How are they going to get money back? And does Celsius have the ability to go through Chapter 11 successfully, come out on the other side, and pay out a lot of the retail participants in this? Right now, doesn't look so good. George, going to throw it up to you for your take, though.
Yeah, I have a lot of thoughts going through my head right now, but the first thing I'd say is, if you're going to have a crypto token, don't call it sell. Don't call it sell. It just sounds like...
I didn't think about that. That was good.
I don't know. We got to start putting that through like marketing things. I don't know. I feel like crypto companies always fail in that capacity.
We need marketers.
Yeah. Bitcoin has a marketing problem. So do all the other ones. When it comes to this balance sheet hole, can someone explain to me what a balance sheet hole is, right? Like I spent 5 years in investment banking, and the only time the balance sheet didn't balance was when some silly first-year analyst, Will's favorite, wasn't doing something correct when they were looking at the financials. So what is a balance sheet hole? Is that bad debt? If that's bad debt, that's still a liability. It's just bad debt. So there's that. Also, this mining thing, Will, you know as well as we do, I can probably go buy like 10 ASICs right now with, just a quick loan from like my brother. I don't know. I don't really have much to say other than I think Celsius is kind of in for a pickle. My least favorite thing in what they're doing now is that they're doing the Chapter 11 bankruptcy rather than filing bankruptcy as a broker dealer, which means that they do in fact believe that the assets they hold are their assets rather than their customers. So retail comes out on the bottom again. I didn't want to latch on to what I had to say. Sorry, I didn't really go anywhere with that. Just airing my...
It was great points. I like the sell token part.
Yeah.
Wendy, go ahead.
I actually learned a lot from what you said, though.
Oh, did you?
I did. I did because
George,
the balance sheet hole, like what is a balance sheet hole? Like when I balance my family's budget for the month, like we don't have any holes in the budget because we have a certain amount of money that we have to spend. I don't know. I learned from it. I've never heard that term. And I learned about it in crypto.
Yeah, the balance sheet should balance, It's called the balance sheet.
Anyways,
I'll take
money
it in
is
a
going
different...
out. It still went out. It's still gone. It's gone. Right? Sorry.
Yeah, I mean, it would seem that way. Maybe we'll get some more clarity on this whole as the story progresses. I think over the next cycle, though, we're going to see a lot of precedent-setting law take place in the courts. And we've spoken a little bit about this when it comes to intellectual property, what's going on in the metaverse and with Web3 and NFTs. I think that this is going to contribute to some precedent-setting law when it comes to bankruptcy court and crypto companies. And that's going to be, I think, really interesting to watch play out. There was a quote in a Reuters article this morning from Stephen Gannon, who is a partner at Davis Wright Tremaine. He said he thinks it's going to take about 6 months minimum for them to develop a plan and get out, which sounds like a really long time for these customers who are waiting to find out what's going to happen to their funds. I can only imagine the anxiety that people who had funds or who have funds on Celsius are feeling right now. And I want to say, though, that we should look at this story if you're new to the crypto space and use it as an opportunity to educate yourself, learn about self-custody, learn about, when things maybe sound like they're too good to be true. And you don't always have to steer away from them, but you should understand the risks before you get into them. So I think that we can all learn from what's happening here. And if you're new to crypto, it's not all doom and gloom. But Will, I saw your hand go up.
Okay, I'm going to take this a techie nerdy corner for a second because that's my obligation as being part of the show. Really interesting corollary to this whole story is the DeFi debt that Celsius had, right? So not only did they have a lot of debt, outstanding obligations to a bunch of companies in CeFi, centralized finance or traditional finance, but they also had a lot of debt to DeFi applications. And these are smart contracts on a protocol. And the most interesting thing about this is that Celsius had to pay off that DeFi debt before it could pay off anything else. Before it started going down the debt stack and paying off CeFi, TradFi partners, they had to pay off the DeFi debt. Now, why does that matter? Well, when you're looking at your liabilities and you're starting to make those payments, right, you have to choose which one needs the dollars first. Who is going to get your first stack of dollars to be able to pay off that debt? And you call that senior debt. And in most cases, you're going to pay it off to people who you want to work with in the future or who have the tightest contracts on you, who can basically squeeze you the hardest. In this case, the DeFi protocols have the most leverage because if you don't pay it down, then you get liquidated. You have to pay off that debt. Otherwise, it's gone. There's no human on the other side. It's just a computer. It's going to take your money away and you can't get it back. So that's why we saw Celsius go through its MakerDAO loans and pay those off as quickly as it could to get the collateral back. And then it went through Aave and it paid off its debt to get its collateral back. And it kept doing that for all the DeFi loans that it had outstanding. And then it was able to take that collateral and start paying off its other debts. So this is one of the more interesting things that we're looking at, like debt structures, which again, I understand it's a pretty nerdy topic, but it is important going forward. If this is going to be like a thing for crypto and for traditional finance, you're going to see DeFi become this cornerstone product because of how people have to interact with the debt structures.